This week on the Business Owner's Corner, I want to talk about establishing a 401k in your business. In the life cycle of a lot of businesses, you get to the point where things become a little more profitable. You might be adding employees and adding staff, thinking about how you want to retain them long term. You might want to pay less in taxes, save for your own retirement. And one of the most popular ways to do that in the retirement planning world is by establishing a 401k plan. A lot of people jump into this without fully appreciating what they're getting themselves into beforehand. And there are 3 C's of establishing a 401k that I want to cover today that everybody needs to be aware of before they set up and sponsor a plan for their business. The first is cost. When you establish a 401k plan, you have to get some professional help from a number of parties. One of those parties is called a third-party administrator. What a third-party administrator does is creates what's called a plan document and some other disclosures that you give to your employees and participants and notify them of every single year that define what's in the plan, what the plan does, what it is. They make sure that the plan itself and that governing document, the plan document, adheres to the IRS and Department of Labor's regulations, and they help you administer the plan over time and make sure that you fall into formalized compliance standards. The 401k, Section 401k of the Internal Revenue Code exists because the government wants us to save for retirement. They want businesses to offer these to their employees. They want business owners to save for their own retirement. But what they don't want is 401k plans to be set up that benefit business owners more so than other employees of that business. So every year you have to go through this compliance testing to balance or grade the scales and make sure that they're not tilted too heavily in favor of the business owner. If they are, you have to even them out through what's called a corrective distribution or a number of other ways. A third-party administrator is the entity that helps you do that. This is really deep accounting type stuff, and please do not try to touch that on your own. You definitely need an expert for that. Once the trust itself is set up with the help of a third-party administrator, then you open a 401k account in the name of that 401k trust somewhere. Usually that's at a brokerage firm or an investment provider's firm. Oftentimes usually you have some kind of financial or investment advisor that helps you select funds that participants can choose from. You don't necessarily need that, but most people choose that. And usually you have some kind of record keeper that helps you track contributions into the plan. So if Susie is going to defer $100 out of her paycheck and contribute to the 401k, record keepers will offer an online portal for Susie to log in and see her balances, make changes to the investments, and request distributions without you having to be involved. So those are primarily the 3 types of parties involved when you establish a 401k plan, and it really makes sense to hire all 3. You definitely don't want to do the compliance, the TPA work yourself. You can get away with doing the investment work yourself if you're really dotting your I's and crossing your T's and you know all of your fiduciary responsibilities. The record keeping is probably something you want to outsource as well. And these things come with a cost. So you have to weigh that cost against the benefit of establishing the plan. The second C that I want to cover is compliance. Like I say, you can't operate a plan and put more money in for yourself than you do for employees in a way that tilts the scales too far in that direction. They have to be balanced. And there's a number of tests that your TPA firm will go through to make sure that you're in compliance every single year. But on top of that, you have a responsibility to deposit participant deferrals within 7 days of the date of the paycheck. So if Susie's putting $100, if Susie's making $1,000 in a pay period, and she wants to put 100 of that $1,000 into the 401k plan, well, you cut her paycheck and then you have that $100 just left over in the business bank account. You have to take it and deposit it into Susie's account in the 401k plan within 7 days. And this is, I don't know this for fact, but I would assume it's the number one compliance issue that the Department of Labor runs into when they're going around auditing 401k plans around the country, which they do. So you need to make sure that you have an adequate payroll system set up to be able to process these deposits on time, because if you don't, it's probably going to get you in trouble at some point. The third C is compensation. And the reason this is important is it's your own compensation that determines how much the business can put in on your behalf. So here's what I mean by that. If you own an S corporation, you have some money that you make as W-2 compensation. You have other money that you make as profit distributions from the business potentially. The amount that you can put in for yourself through profit sharing contributions to the plan depends and is limited by your W-2 compensation. There are a lot of people out there who intentionally suppress their W-2 compensation a little bit to take out more as profits because you bypass the Social Security Medicare taxes that way. It's a nice tax saving maneuver. But when you suppress your W-2 comp, your profit sharing contributions are limited to 25% of your W-2. So if you have some kind of tax philosophy, how you're operating an S corporation now to limit taxes, well, you might need to revisit that if you establish a 401k plan for the purpose of putting more money in for yourself. And you should be aware of that before you establish a plan. There are more areas of complexity than this within 401k plans, but those are a few of the high points you need to know about before establishing a 401k in your business.